Hello and welcome along to the Property Academy podcast. I'm your host, Ian McKnight.
Andrew Nicol.
And today on the show, we're talking about the 5 lessons we've learned from the best-selling book, Rich Dad, Poor Dad.
This was a great one back in the day. So I remember reading that. I must have been 15, 16 when I read that.
Amazing.
So it was a wee while ago. They came on stones, carved at that stage.
And what we're going to do today is not just go through our top 5 lessons, but we're also going to apply them to the New Zealand property market and how you can apply what Robert Kiyosaki talks about in the book to your property investment strategy. Now, Andrew, walk us through the premise of this book for anybody who hasn't read it yet.
Okay, so Robert Kiyosaki featured here for those of you on YouTube. He looks a lot younger there than he does today, but I see him, he's making a comeback on the TikTok, same as us.
I see him on the TikTok too.
He must be, the TikTok too. He must be about 100 now. Anyway, Robert Kiyosaki grew up in Hawaii back in 1950s, and he had 2 dads, well, this is what he says. So he had a poor dad, his real biological father, sounds familiar, who was highly educated. He had a doctorate degree, and he believed in the standard career path in life. So go to school, get an education, get a stable job at a good company, and work your way up from there. I think his dad was a teacher from memory, and despite being educated, poor dad always struggled with money. He never had any extra money. Then he had rich dad, which was his friend's dad, but he just decided he wanted to call him dad as well. I would too if he had all sorts of money. And he was not highly educated at all. He left school after 8th grade, owned businesses, and despite being uneducated, had money. He talks in the book about his lessons from both of them and their conflicting views about life and money.
And look, whether or not Rich Dad's a real person, we were having this argument offline, is he real or not? I think it is a very useful mechanism for comparing 2 different schools of thought, a poor mindset and a rich mindset. So let's talk about what those 5 lessons are and how they apply to the New Zealand property market. What's number 1, Andrew?
Okay, number 1 is the standard career path, which doesn't guarantee financial success. So what that means is this is what most people are doing. This is what most people listening to the podcast and,
and me,
which is, you go to uni, Ed Special, get a job, climb the career ladder, get a house, sell it, get a bigger house, but it doesn't actually get you ahead. It doesn't make you financially secure. And, I guess this is applicable to the New Zealand market because, well, it's what we're all doing most of the time.
I think a lot of people are doing that, especially upgrading the house routinely, thinking that that is making financial progress.
Yeah, I actually spoke with some investors last week, and the normal, hey, we're going to downsize at retirement came up, which is such a fallacy. People don't actually get ahead by downsizing.
Now, principle number 2 is mind your business. Now, let me explain what this means. Look, when you work for somebody else, your labour is making them money. So what you really need to do is build your own business. Now, that means you need to start earning money from something other than you working for it, other than your labour. So effectively, he wants you to start earn while you're not working. Now, the standard career path, that is about trying to increase the income you get from your own labour, which is fine and great, and you should keep doing that. But here, when he's talking about minding your own business, this is about earning income without the need for you to work for it. Now, I'm not talking about starting up a standard business. In this instance, Rich Dad owned grocery stores. But this can be owning property. It can be owning shares and other assets too. So if we're thinking about how this applies to the New Zealand property market, for you, it probably means setting up multiple investment properties that go up in value over time. Now, if I just think about my personal situation, one of the properties I own went up by 80 grand in the last 12 months, $80,000. So that's 80 grand of what we call economic income. I mean, it's not in my bank account, but it's on my balance sheet. It's capital that I've now got.
And you don't have to pay tax on because it's just capital growth.
As long as I don't trigger bright line tests, no tax on that. But 80 grand that I did not have to earn. And it's not until you stop and you think, how much did it go up by in the last year, that you start to think, oh my gosh, that's actually quite a bit of money that I did not have to earn. So number 1, don't just follow the standard career path. Number 2, you've got to set up other ways of building your wealth other than you having to work for that money.
Number 3 is accumulate assets, not liabilities. And this carries on from lesson number 2. The way you build that business or those assets is not by giving up your job, but by using the income you get from your job to buy assets. So it's absolutely fine and normal to have a job, but take the revenue, the income that you're earning, and actually use that money to buy assets. And most people take on liabilities rather than assets, and one of those is your own home. So one of Rich Dad's philosophies, which Ed and I often debate, is that Rich Dad considers your own home a liability because it's not an income generating asset. Edward, the economist, he says no, it's an asset, you own it, so it's an asset, which, you know, Ed can be rich, poor dad in this example, and
well, I am compared to you.
Take his degree and have his house and his liabilities. But, you know, you want to be thinking about things aside from that new car or the bigger house. And I get it. I get that, you know, when you work hard, you kind of had this mentality, well, I've earned it. I've deserved this. And I've had investors say to me, oh, you know, that's so important to us. We want it. Hey, if it's important to you and you absolutely want it, do it. But at the end of the day, you want to use your income generating years to buy assets, not liabilities. And the way you can apply this is, well, maybe don't upsize or buy a bigger house right now. Maybe don't spend another 300 grand on renovating it right now. Put that money into assets first and then do those nice to haves later on once you've got the assets, or use the assets to buy the toys. In fact, one of Robert Kiyosaki's things, I saw that he was talking about buying Ferraris, I think it was. I don't know the first thing about cars, so maybe it was a Ferrari. And he said that he used to, rather than ring his guy, because he had a supplier for Ferraris, this will tell you how successful he is now, rather than ring him and say, hey, I want to spend $500,000 on a Ferrari, what he'd do is he'd use $50,000, which was the down payment for the Ferrari, to buy a house. I mean, this is in the States where you can buy properties for $50,000. And then he would use the income of that to make the payments for the Ferrari.
Oh, that's quite clear. I quite like that.
Oh, now you agree with Rich Dad, do you?
I didn't say I never did. I prepared this episode for you. Now, it's actually quite true. So I was at somebody's house over the weekend, and I know they were thinking of selling. I was thinking, this is a really nice house. Like, maybe I should buy this house.
Oh,
and I was thinking,
Edward.
Well, and then I was thinking, well, how could I do that? Oh, I could sell that investment property, release the equity. I'm like, I could make this happen. And then I thought, no, Edward, your job is to buy more investment properties.
Absolutely.
Because I do not need more what I call consumption goods. I don't need to spend more money on my lifestyle.
No.
Especially not right now.
Well, you got no kids, no partner. You got nothing to live for.
So true. That's why I'm thinking I need investments. That's where I am in my life. That's what I've got to build. Now, number 4 is that the goal is to eventually have income generating assets that cover your expenses. Now, coming on from lesson 3, once we build up those assets that Andrew just talked about, you want to set them up so that they do cover your expenses. You know, this is where you're living off that business that we've created. So lesson number 2 was you want to start earning economic income or building your wealth other than just trading your time. We're going to do that by buying assets rather than accumulating liabilities. And then once we've done that, we're going to live off the income that they create. Now, doesn't that sound familiar? How do we apply that to the New Zealand property market? That's essentially the idea behind the golden goose strategy. And look, with the golden goose, there's a bit more to it than that. We go through a bit more detail than what they talk about in this book, because this book's more general. Whereas, of course, the golden goose is about targeting a 4% net yield, using high-yielding properties to do it, and a couple of other things there. But effectively, that is the same thing as we talk about when we, here on this show, talk about the golden goose. Now, what is lesson number 5, Andrew?
That most people are playing not to lose rather than playing to win. And I think this is so true. It always surprises me when I'm talking to an investor that's maybe really conservative that they become so fixated on even the remote possibility of a loss, even if it's a paper loss, rather than thinking about the much more likely outcome of a gain. And rich people they lose money because they take risks, but they lose money in, isolated instances, and it doesn't stop them from investing again to make money. And they'll invest sometimes in things like stocks or real estate, which may go down in value in the short term, and they're happy to take the risk because they know that they're more likely to have gains in the future. A lot of people are too scared to invest because they don't want to lose money. They don't want to have any possibility of losing money, and the only way you can guarantee not losing money is to not invest. But then you do guarantee no gains either. So they avoid risk rather than accepting that you're in business and investing has some risks to it. The way we can apply that to New Zealand market is we do see investors who worry about this. You've just got to focus on the risks and mitigate them as best you can, but then focus on the gains that are far more likely and far more proven on a long-term basis than fixating on the short-term losses.
I'll give you an example of that. I saw an email on your desk while I was working in your office this weekend, Andrew, from an investor. Not that I read stuff that's on your desk, but I did in this instance. And
did you rummage through my business card?
Just your drawers. And it was from an investor who'd got a reporting letter from their lawyer. So this is when your lawyer looks through a contract and just tells you the important parts so you don't have to read it yourself. Now, the investor had then emailed you with a whole heap of questions about it. So one of the things was the settlement date will be 10 days after the title or the code of compliance is issued. And they'd said, now, do you have any data about how quick the Christchurch City Council is about delivering titles and code of compliance? Look, it's so detailed, it doesn't matter. It doesn't matter.
Yeah.
It makes no difference between whether this is going to be a successful investment or not. I mean, we're talking about a magnitude of a couple of days, and you'd sort it out anyway.
Yeah.
So there is a real risk if you're so worried about all of the details sometimes. And of course, look, I'm not telling you not to be detailed, but sometimes you can just get in your own way because you're so worried. But it doesn't matter.
That investor went unconditional today.
Yeah, well, that's got to be good.
Because they got the phone call saying none of this matters.
Oh, is that what you did?
Yeah, none of this matters. Let's just focus on the deal that you're getting.
And it might be scary the first time. The first time you get a reporting letter from it and that you think, well, my lawyer's written this out, so it must be scary. No, that's just standard. It's like standard process. You get your letter, they tell you the details. They'll flag anything that's really of concern. So that's an example of one of those lessons from the book about, play to win, don't play not to lose, that I think we can all apply. So just a quick recap, those 5 lessons again, that standard career path, go to uni, get a job, get a house, get a bigger house, get an even bigger house, try get another promotion, get a bigger house. That's not going to guarantee financial success for any of us. So what do we got to do instead? We've got our mind, our business. We've got to find ways of generating income or wealth other than us just working for it. We're going to accumulate assets rather than liabilities in order to build that income or wealth stream. And then we are going to use those assets to live off them and provide us an income. And the way we're going to make sure this is successful is we're going to play to win rather than play not to lose. So I think those are really the 5 key themes, at least for us, while we're reading this. Now, I do think it's important to note, though, Andrew, this really is more of a motivational book, as opposed to a play-by-play how-to guide. And
would someone get a book that was a play-by-play guide?
There may be one coming out mid-October, which is very specific to the New Zealand market. Now, I do not see that as a major criticism. I know I've read criticisms of this book. People online say, it doesn't give you a play-by-play. This has been written to be applicable across the world so that people can think about their finances and be like, hey, do I have a poor mindset or do I have a rich mindset? And I think that's a beautiful thing.
Absolutely. And we're going to, so Rich Dad, Poor Dad, or Robert Kiyosaki has actually got a game called Cash Flow, which I've never played, but we did buy a copy for the office. So Ed is going to come around this weekend and I'm going to beat him with my Rich Dad mindset.
It'll be because I'm too busy fumbling through your drawers. Right, let's wrap it up there. But please don't forget to rate, review, and subscribe to the Property Academy podcast. Really does help us get the message out to more people. And hey, if you want to grow your portfolio, if you want to build some of these assets, here's the way to do it. Come in for a portfolio planning session. Easy way to find out more about that. Whip out your phone, send us a text. Text the word plan to 5522. We'll get in touch, see if it's the right fit for you. Thanks for listening to the Property Academy podcast. I'm your host, Edward Knight. And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.